I want to begin this analysis by addressing a fundamental misunderstanding that permeates almost all modern financial commentary. When the mainstream media and finfluencers discuss the end of the petrodollar system, they inevitably point to external threats: the rise of the BRICS nations, China's burgeoning yuan-denominated oil contracts, or Saudi Arabia's recent willingness to entertain non-dollar currencies for energy settlements. While these developments are certainly real and noteworthy, they are not the cause of the system's decline. They are merely symptoms. The petrodollar system is not being dismantled by a foreign cabal or an overseas coup. It is dissolving from the inside out, a victim of its own success and the changing arithmetic of the American energy landscape. This internal dissolution is the most important structural story of the next decade, and it will dictate exactly where global capital flows next. If you have assets tied up in a 401k, a portfolio of stocks and bonds, or a savings account intended for your retirement, this transition is not just a headline, it is a total shift in the landscape of value. We aren't looking at a sudden collapse in the way doomsday theorists suggest. Instead, we are witnessing a durable, long-term migration of where value is stored and how it is generated. To survive this, you have to look past the political theater of BRICS and understand the mechanical gears moving beneath the surface. I have spent decades studying the way monetary systems shift, and the one constant is this: the most consequential changes move slowly, then all at once. The investors who recognize the mechanism early, rather than reacting to the news late, are the ones who preserve their wealth across these historic divides. Everyone else pays the price of late adjustment. To understand the end, we must understand the beginning. The petrodollar system was never just a custom. It was a rigid, high-stakes geopolitical bargain struck in 1974. Following the volatility of the 1973 oil shock and the final collapse of the Bretton Woods gold standard, the United States reached a historic agreement with Saudi Arabia. The terms were simple. The Saudis would price their oil exports exclusively in US dollars and recycle their massive dollar surpluses back into the American economy by purchasing US Treasury bonds. In return, the United States provided a security blanket, military protection, intelligence sharing, and political support for the House of Saud. This agreement effectively replaced the gold standard with an oil standard, creating a non-negotiable global demand for the dollar. Every nation that wanted to fuel its industry had to hold dollars, and the most productive place to store those dollars was in the debt of the U.S. government. This arrangement provided the United States with what economists call exorbitant privilege. It allowed the U.S. to run massive deficits and borrow at scale from the rest of the world without facing the typical inflationary consequences. The entire world was forced to subsidize American debt because they needed the dollar to buy energy. But here's the part that most analysts are too timid to say out loud. The arithmetic that made the 1974 bargain possible has vanished. The United States is no longer a desperate energy importer. In a stunning reversal of history, the U.S. has become the world's largest oil and gas producer, surpassing both Saudi Arabia and Russia. When the U.S. becomes a net energy exporter, the fundamental incentive to protect the Hormuz corridor or to garrison the Persian Gulf begins to evaporate. The U.S. no longer needs the Middle East to ensure its own energy security, and as that strategic imperative fades, the enforcement of the petrodollar recycling mechanism fades with it. This shift is not a matter of foreign policy isolationism. It is a matter of mathematical reality. When the U.S. stops being the primary customer of Middle Eastern oil, the recycling loop breaks. If the Saudis or the Emiratis are selling more oil to China than to the U.S., they have less reason to hold their wealth in U.S. treasuries. This is why you are seeing the demand for U.S. government debt shift. For 50 years, the petrodollar recycling mechanism was the marginal buyer of U.S. treasuries, keeping yields artificially low. Low yields meant cheap mortgages, cheap corporate debt, and a booming stock market. But as that structural demand base shrinks, yields must rise to attract new, more skeptical buyers. For the average investor, this is the hidden danger in the 401k. Many people in their 50s and 60s believe they are playing it safe by shifting their retirement funds into long-duration bonds. However, in a structural transition where yields are rising not because of a temporary inflation spike cyclical, but because the world's largest buyer of debt has stepped away, structural, long-duration bonds become a liability. When yields rise, bond prices fall. We are moving into an environment where the annual cost of servicing the U.S. federal debt, now nearing $40 trillion, will soon exceed the entire national defense budget. This isn't a theoretical risk. It is a mathematical certainty on our current trajectory. If the anchor of petrodollar demand is gone, the safety of the bond market goes with it. As the U.S. pulls back from its commitments to the old petrodollar world, it isn't retreating into a shell. It is reorienting its focus toward the Western Hemisphere. This is the pivot to the Americas that is currently being executed with precision, yet it remains almost entirely unremarked upon by the financial press. The U.S. is seeking to secure its supply chains closer to home, moving away from contested maritime corridors and toward resource relationships in its own backyard. This explains the sudden and intense strategic focus on Venezuela. Despite years of political friction, Venezuela holds the largest proven oil reserves on the planet. Its heavy crude is exactly what American Gulf Coast refineries were designed to process. A normalized relationship with Venezuela isn't just about politics. It's about replacing the Middle Eastern energy loop with a secure, local, and domestic adjacent energy supply. However, the pivot doesn't end with oil. If oil was the commodity of the 20th century, critical minerals are the commodity of the 21st. The AI revolution, the electrification of the grid, and the advancement of military technology all depend on a specific set of physical inputs: cobalt, nickel, copper, and rare earth elements. Currently, China dominates this space, controlling roughly 60% of global rare earth processing and securing mineral rights across Africa and Southeast Asia. To compete, the United States must look to the one place it has ignored for over 60 years, Cuba. I realize that mentioning Cuba as a strategic investment destination sounds provocative, but look at the geology, not the politics. Cuba is the 5th largest cobalt producer in the world. It holds some of the most significant nickel deposits in the Western Hemisphere, alongside largely untapped resources of copper and rare earths. For 6 decades, these assets have been frozen in time, cut off from the capital and technology required to extract them at scale. As the U.S. moves to decouple its technology supply chains from China, Cuba becomes more than a geopolitical curiosity. It becomes a strategic necessity. The systematic isolation of Cuba's traditional supporters, Iran and Venezuela, is not a series of disconnected events. It is the structural preparation of a theater for change. Just as investment flowed into Eastern Europe before the Berlin Wall actually fell, the strategic logic of the Western Hemisphere pivot suggests that the normalization of Cuba's resource sector is a when, not an if. The investors who wait for the headline "Cuba opens for business" will be too late. The value is captured by those who understand the resource endowment and the strategic vacuum that the end of the petrodollar era creates. To understand how to position yourself for what is coming, we have to look at the last time a monetary anchor was removed. In 1971, when Richard Nixon severed the dollar's link to gold, the safety of the dollar was called into question. Gold, which had been suppressed at $35 an ounce for a quarter century, exploded to over $800 by 1980. This wasn't because the world was ending. It was because the monetary anchor was gone, and the price of hard assets had to readjust to reflect reality. The petrodollar system has served as a secondary anchor for the last 50 years, creating an artificial demand for the dollar that kept the price of commodities and hard assets lower than they otherwise would have been. As this anchor loosens, we should expect a similar repricing. I am not suggesting the dollar will collapse into worthlessness. It will remain the primary reserve currency for some time. However, it will experience a persistent structural devaluation against the things we actually need: energy, metals, and food. In this environment, paper wealth, bonds, and cash faces a headwind, while physical wealth, mining equities, critical minerals, and domestic energy producers faces a tailwind. The demand for materials like cobalt and copper is no longer speculative. It is the physical requirement for the modern world to function. History shows us that every major monetary transition produces a massive transfer of wealth. This isn't a predatory process. It's a mechanical one. Assets that were favored under the old system lose their shine, and assets that were suppressed by the old system find their true value. In 1971, the winners were those who moved into gold and hard assets. In 1974, the winners were those who understood that the petrodollar would create a multi-decade boom in U.S. financial assets. Today, we are at a comparable inflection point. The era of the petrodollar is ending because the world it was built for no longer exists. The United States has outgrown its need for the 1,974 bargain, and the rest of the world is adjusting to that reality. For the patient investor, this transition is not a crisis to be feared, but a structural shift to be harnessed. Moving out of long-duration paper risks and into the new anchors of the economy, Western Hemisphere resources, critical minerals, and hard assets is the primary task for any portfolio in the coming decade. The headlines will continue to talk about BRICS and summits, but you must keep your eyes on the mechanism. The transition is already underway. Those who see it clearly today will be the ones who look back on this moment as the foundation of their future prosperity.